Well, hello again, everybody. My name is Greg Milewski. I'm with Retirement Income Source of Southwest Florida, and we're here today again to do another one of our informational videos just for your education. We want to talk today about Roth IRAs, the power of a Roth IRA. And you may have some idea what that is if you have done any retirement planning already. You may have heard about traditional IRAs and Roth IRAs. Even perhaps your 401k plan may allow you to save money in both options between traditional, what they call pre-tax method, as well as the post-tax or after-tax method with a Roth 401k. I personally put all my savings in a Roth 401k, and I'll tell you why. Because I believe in the power of paying tax on the seed only and not having to pay income taxes on all of the harvest. Okay? Pay tax on the seed now, and you won't have to pay tax on the harvest. Would you rather pay tax on a little seed or pay tax on a truckload of the harvest, right, from that seed? So instead, we say, if you use a Roth IRA, you don't have to worry about what the tax bracket is in the future, which is really nice. I mean, after all, do you think taxes will continue to go up? Probably, right? Well, if you put your money in a post-tax account, you actually will pay tax on it now at your current tax rate and then not get a tax credit on your tax return. But at the end, when you retire, after all those years of working, at the end of your working career, and you retire, you get to use that money anytime you want. And you know what's nice about Roth? You have no RMDs. All of your pre-tax accounts, like traditional IRAs and traditional 401k, where you deferred the income tax, the IRS says, well, now when you retire at 73 years old, you're going to have to start taking money out of your IRA accounts and paying taxes on it. With a Roth account, you don't have to pay any tax ever. You can grow that money to $1 million and never have to pay tax on it. So that's really nice. So Roth is a really great idea for younger investors, especially younger investors who have many years before they retire, what we call a long time horizon before they retire, so they can take advantage of the growth for many years, while they're working. Now, if you want to get started with that, the current IRS rules have limits on how much you can put in these kind of accounts. There's no extra limit with regard to the 401k version of a Roth. You have typical 401k limits that fall under the laws of ERISA for Roth 401k. But for individual accounts where you're starting that by yourself, perhaps in a brokerage account with after-tax money, the annual limit is $7,000 if you're under age 50 and $8,000 if you're over age 50. Your annual contributions are limited, though, by the amount of income you make. There are phase-outs and limits that will cut it off completely if you make too much money. For example, for a single filer, it's $150,000, and for married filing jointly, it's $236,000 in 2025. So that means that if you make too much, you can't even do a contribution to a traditional or to a Roth IRA. But having said that, even that's okay. I say that's okay because if you earn enough to be in that high of a tax bracket, then you might even wonder, am I really better off, deferring the income taxes until being in a lower tax bracket in retirement? Now, in those cases, we sometimes look at other options like leveraging life insurance to use after-tax savings as well. But these are done on a case-by-case basis with an experienced retirement planner. So again, it's not for everybody, and you really need good counsel. You need good, wise counsel when you're talking about whether or not to do a Roth IRA. Now, like a traditional IRA, Roth IRA says you have to leave the money there until you're 59 and a half to avoid any kind of a 10% early withdrawal tax penalty. Because even with the Roth, if you pull out the earnings before you are 59 and a half, you will have at least a 10% tax penalty that you have to settle up on your tax return. Now, there are some exceptions we'll get to in a minute, but that's the general rule. It's a retirement account. You got to leave it there until 59 and a half. That's the magic age. Now, in regard to Roth contributions, the annual contribution that you can put in, $7,000 a year, there are two different 5-year rules involved, okay, to keep in mind. Well, number one is that you have to leave the money in the Roth IRA account for at least 5 years to avoid paying income taxes on the investment gain, okay? Need to leave it in for at least 5 years. Additionally, the other 5-year rule is on conversions, and we're going to talk about what that is here in a second, but conversions also have a 5-year rule to avoid paying income tax on the earnings. You can take out your basis, your cost basis, anytime you want, but if you're taking out the earnings, you have to pay income tax on that if it's not been 5 years. Now, for conversions, what I tell people all the time is don't do them in a vacuum, okay? A lot of people will say, well, when I get to my retirement years, I want to do a conversion from my traditional to a Roth. Sometimes we talk about doing a backdoor Roth, where you put money in a traditional and then convert it quickly into a Roth IRA. Well, the problem is that you can't do that in a vacuum because there are different rules associated with how you take that money out and how long it needs to stay before you don't have to pay taxes. So again, talk to a professional. Now, I mentioned earlier there are some exceptions to the rule for taking early withdrawals and avoiding the tax penalty. I'm not talking about income tax, I'm talking about the 10% penalty. So there are exceptions to taking out Roth IRA money. So assuming you have left the money in there for at least 5 years, okay? After 5 years, where that money's been there, and every year there's a 5-year new rule starts for every year you contribute to it. So every contribution has a 5-year rule. Now, assuming you have had this money in for 5 years, there are ways to take out the money without having to pay the tax penalty. For example, of course, if you die, your beneficiary inherits it without a penalty. If you're disabled and you cannot work anymore in your normal occupation because of total disability, it has to be total and permanent, you can get at the money without a penalty. Things like first-time home purchase, you can withdraw up to $10,000 to cover a first-time home purchase, birth or adoption of a child, and for certain qualified higher education expenses. For example, if the IRS levies you and they're taking tax, they'll let you pull it out of your Roth IRA. How nice of them, right? You also can use this money for unreimbursed medical expenses and health insurance premiums if you're unemployed. Okay, so if you're unemployed, you can use some Roth money and not worry about paying the 10% penalty. And you won't pay any income tax either on the gain as long as it's been there for at least 5 years. Now, you can also have an exception to the penalty for things like returning excess contribution. If you put too much money in there and then you leave it too long, you get a penalty from the IRS because you left it there too long. So the IRS says you can take it back out without us penalizing you. For domestic abuse victims, there's a certain amount you can take out. For military reservists, what a lot of people don't know, military reservists who have pay gaps, they're waiting on pay. There are ways to get the money from a Roth IRA without paying any kind of a tax penalty. So again, these are some nice exceptions to the rule, the normal rule, but what I always say is get some professional guidance before you decide to do a Roth or you take money from your Roth IRA account. So again, if you like these informational videos, hit the like button and subscribe to our channel. Bye for now.